The future of your credit will change and how you can adapt to it and make the most out of it. That's the topic for today's episode. And without further ado, let's dive in. Hello, everyone, and welcome back to another episode at Nova Rise Invest. For those who are tuning in for the first time, this is your channel for financial education. So today we're going to talk about credit, what's happening to your FICO score, and how you can adapt to those changes so you can make the best out of it. Now, I understand that we have viewers from all kinds of levels. So if you're brand new to this channel, welcome. And if you've never heard about FICO or credit for the first time, let me give you a brief introduction. So FICO is just basically your credit worthiness. So every time you go to a bank or a lender to apply for a mortgage or a personal loan or a credit card, you are going to be reviewed based on your credit score. And that credit score typically is the FICO score. But according to this article that I'm about to show you, that is about to change, and FICO will no longer dominate the credit scoring market. So without further ado, let's just go straight into what I have prepared for you today. And so that's basically what we have here in this article from the Wall Street Journal. FICO scores hold on the credit market, it's slipping. So for those who have been following us quite some time and are somewhat familiar with the topic of credit, you will know that for decades, nearly every consumer decision revolved around the 3-digit number called the FICO credit score, right? However, big lenders are moving away from FICO according to people familiar with the matters. Examples of those lenders are Capital One Financial Corp and Synchrony Financial. They don't use its scores for most consumer lending decisions anymore. They're becoming a smaller factors in some underwriting decisions at JP Morgan Chase and at Bank of America. So now you might be wondering, what's going on? Why is this being done? Well, a key financial regulator, meanwhile, is encouraging banks to de-emphasize credit scores in an effort to expand access to affordable credit. And housing finance giants like Fannie Mae and Freddie Mac are considering allowing lenders to use other scores when evaluating mortgage applicants. And then as we continue, there are a few reasons for the shift. Many lenders now reveal a wealth of new data and use it to refine their own proprietary scores that they say are better to predict who will repay and who won't. And if you come to think about it, you might be wondering, okay, well, what's that wealth of data? It's been in our face the whole time. So need cash, companies are considering magazine subscriptions and phone bills when making loans. In fact, if you've been following me for quite some time, this is something that I've already covered in prior episodes. For those who are really brand new to credit, or maybe you made poor decisions when you were younger, but now you're trying to improve your credit history, the best way to do that is by just paying your bills on time and reporting those payments. So I've covered in prior episodes that you can leverage a company like Rental Karma, for example, and that will allow you to upload a copy of your lease and prove that you're actually paying your bills on time. So it seems that a lot of lenders are now starting to look into that type of data to determine whether you are creditworthy or not. And this is especially beneficial for people who, let's say, have had less than a 2-year credit history, because it seems that FICO tends to penalize those borrowers or those applicants who have less than a 2-year credit history. So if you're within that range, now there's hope for you, because, hey, you can prove that you've been making timely payments for your rent, for your cell phone, maybe your internet, maybe your water, maybe your electric bill. You can prove that you've been paying on time, let's say for the last 12 months or so, and then they will have actual data that backs up your good behavior to prove that, hey, if you've been paying those bills on time, then there's a high likelihood that you can also repay the loan on time. So now back to the screen. FICO scores are good, but they're not perfect, according to Roger Hochschild, who's the Discover Financial Services CEO. FICO's warning influence could become a problem for the roughly $16 billion company behind it, which is the Fair Isaac Corporation, because FICO scores, they account for about 40% of the company's revenue. Well, let's see what happens, right? And as we're scrolling down, according to this, we see no evidence in our business to indicate the marketplace is using the FICO score less, said a FICO spokeswoman. We realize lender use and, in fact, encourage lenders to use the FICO score in conjunction with proprietary data and models to make the best decision possible. The spokeswoman said that FICO did materially increase the price of FICO scores for 25 years after the score's introduction. And after decades of inflation, the real price of the FICO score effectively has decreased. Now, if you're like me, right, you will typically check your FICO score before applying for a credit card because you want to make sure that you can, in fact, qualify to get one of those cards, right? And you typically go online and you check what are the qualifications that are needed from you as an applicant, whether it's a FICO score of like 700, what is an 800, or if you're okay with a 600 FICO scores, we don't know, right? So what this article is saying is that once again, borrowers often check their FICO scores before they apply for credit, but the guessing game, it's getting harder because now big banks are increasingly approving applicants with low FICO scores or rejecting those with high scores if alternative metrics point in a different direction, lender executive said. Just like I mentioned, you can have a poor FICO score just because you don't have the longest credit history, but that doesn't mean you're not paying your bills on time. So you don't want to get excluded from enjoying or from accessing some of those financial products just because you didn't have a full 2 year to prove that you're actually been making your payments on time. And as we scroll down, we find out more about why this is happening, right? So lenders' efforts to rely less on FICO scores accelerated during the pandemic. The scores don't reflect deferment or forbearance program, making it harder for lenders to evaluate borrowers. If you come to think about it, it kind of makes sense, right? Because what happens when you're applying for a forbearance program or when you're pausing your mortgage payment? The interest just get added back up to your total mortgage. So that means that your debt is growing bigger and bigger and bigger, and that's not being reflected in your FICO score. And that translates to the lenders as you becoming someone who is of higher risk. Because if you have a higher debt, that means you will have less money to pay them for that new loan. So that's definitely a factor that needs to be taken into account, because if they know that you have more debt, that means that the amount that you're going to get approved will, possibly be a lot less, because they don't want to set you up for failure and have you foreclose or a default of both loans, right? Now, as we're scrolling down, bank credit executives say their own internal data and proprietary scores are more reliable. They factor in information from credit reports, deposit balance, and overdrafts, and their own prior lending relationship with applicants. That's why I have reiterated in the past over and over again that it's very important to maintain your relationship with this bank, with the bankers, with the people that you interact with on a daily basis, and the bank. That is very important, because I've read countless of comments saying, well, I've applied online and I got my credit card denied. And I've suggested multiple times that the best way to get your credit application approved is by just simply showing up in person to the branch. Because when you come to think about it, every time you apply for a credit card, let's say online, you are subject to what the algorithm has been pre-programmed, right? So this person has to have this, and that, but there's no human component behind the application process evaluating why is your case special, right? And so chances are when you apply it online, and if you don't meet exactly what the qualifications are, your application is just simply going to get denied. But if you do show up in person and you have an actual human being evaluating your application, whom you will probably build a relationship with because they can access their system and take a look at, your behavior, how your accounts have been performing over the past couple of years, hey, then that means you have higher chances of getting that application approved. In fact, we went through a similar experience at a bank where we were trying to get approved for a credit card, and we were not getting approved because our company was relatively new. But the minute we showed up to the bank, we instantly got our application approved, and we actually got it approved for a very large sum. So once again, it's important that you build those relationships. So a lot of changes are coming, but hey, you can adapt to it. So one of them is to maintain that relationship, maintain a strong relationship with the bank. And the second is to continue to pay your bills on time. no reason why you shouldn't pay them on time before, but just reiterating that you should pay them on time with more reason now if you want to get access to better lending terms, right? So now moving along, but before we do that, if you're enjoying this episode, do not forget to hit the like button right here at the bottom, and also share this episode with other people like you who are looking for information of this kind. Now, back to the article here. For banks, one benefit of their own scoring system is their ability to tweak them when problems arise. Several years ago, JP Morgan noticed that when borrowers transferred their credit card debt to a personal loan, their credit FICO score often increased because the share of debt they carry compared with their card's spending limits have fallen, a person familiar with the matter said. In fact, there has been a hack that I've applied over and over again, and I'm sure that if you've been following this channel for quite some time, this is a hack that you are probably very familiar with, because that's just how the FICO system is set up. So in this case, it doesn't work too much for our advantage. But then if you have to put yourself in the shoes of the lender, it kind of makes sense why they want to do this, because the reason why they want to evaluate your credit worthiness is because the banks are in the business of making money. So they want to make sure that you are able to repay that loan, right? So if you are moving your debt from your credit card to a personal loan, that just simply means that you're moving the debt from one place to another, but that doesn't mean the debt disappeared. The debt is still theirs. But in the FICO score, it shows that it's not there. And when it comes to a bank giving you the loan, now they want to make sure that they're factoring the fact that that loan is still existent, because that it's going to determine how much money you're going to get approved. But if the bank is not aware of that, then that means they are risking lending you money that they might possibly never see back, because now you're just getting burdened with that over and over again, right? Not to necessarily say that I agree with them, but it's just simply my way to help you look at the other side of the coin, right? Now, scrolling down, JP Morgan still uses FICO score for mortgages and auto loans, but relies on FICO scores a lot less for many credit card originations. FICO, it's becoming a smaller factor in underwriting decisions at Citizens Financial Group, Inc. Now, when shoppers apply for its buy now, pay later loans, the bank considers factors including the products that they're buying, according to a person familiar with the matter, right? So Synchrony Financial earlier this year said that it has switched to VantageScore, a rival offering from the major credit performing firms. For those who are not familiar with the system of the VantageScore, that's the scoring system that you will see on Credit Karma. So a lot of you who have downloaded the Credit Karma application, you will see that your score, the one that appears on Credit Karma, differs slightly from the one that you see on your FICO score. And that's because they're actually basing their scoring system on a different system itself. So if you have Credit Karma, you will get access to your VantageScore. And if you have access to Expedia.com, let's say, for example, you will get access to your FICO score. Now, scrolling down, FICO has a big advantage. Investors rely heavily on the scores to decide whether to buy package up consumer loans. So for those who don't know what that is, I'm sure that if you do have a mortgage at some point, you will know that sometimes you wind up getting a letter that says, hey, your loan has been sold to this other bank and now your mortgage payments have to be paid for this bank. What this article is saying is that one of the big advantages of leveraging the FICO score is that a lot of those investors who actually buy those mortgages by the bulk, they use FICO to determine how much that mortgage is worth. So let's say, for example, investors are willing to pay a little bit more money to buy a mortgage that is performing well for people who have an excellent credit score. Now, if you compare that package loan with a loan that it's rated good as opposed to excellent, then that means that those mortgages are going to be worth a little bit less than the other one. So that's basically what this article is saying, right? And then as you scroll down, FICO largely has Fannie Mae and Freddie Mac to thank for its hold on the securitization market. Decades ago, they decided that lenders using credit score to underwrite mortgages will have to use FICO score if they wanted to sell the loans to the pair. Once lenders were using FICO for mortgages, they moved to using them for nearly everything else. But FICO may soon face competition in the mortgage market because Fannie Mae and Freddie Mac are considering allowing lenders to use other scores, including the Vantage scores and lending decisions. So now you know, Three things to keep in mind. One, always maintain a good relationship with your lenders, with your bankers. Always keep a healthy bank account with them and keep a healthy credit behavior. So that way, in the event that they do adapt those changes, you are ahead of the game, so to speak. Second, always pay your bills on time. That shouldn't be any secret. That's a no-brainer. And third, now, if you happen to be using Credit Karma, you're maintaining your Vantage score, continue to do that, because in the near future, they are going to be leveraged or used in the approval of any type of financial product that you might be interested in. So now back to the article. Fannie Mae and Freddie Mac earlier this year notified Vantage Score that its newest score passed their credit score assessment, meaning it met a minimum accuracy threshold according to people familiar with the matter. And all these changes are not only for banks. In fact, bank efforts to decrease their reliance on FICO score recently got a boost from Washington. So it's happening at a major scale because the market wants to create more opportunities for those applicants, for those customers who have been sort of like left out because they didn't meet certain criteria on the FICO score. So I want to hear your opinion. What do you think? Do you think that FICO is going to disappear forever, or do you think they're here to stay? My personal opinion, I think FICO will stay, but they're going to be used more on the mortgage/car loan side, and that maybe the Vantage score is going to be implemented more for credit card applications, keeping those two separate. But that's just my humble opinion. I really want to read about what you have to say. What's your opinion? What do you think is going to happen based on what we just went over today? And while I still have you here, do not forget to check this episode right here. That's going to help you complement pretty much everything you just learned today. And until then, I'll see you guys soon and take care. Bye-bye.